Hello and welcome to Trading Flag Patterns, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach here at Charles Schwab, and I am joined today in the chat by my good friend Kevin Horner, who is also an education coach and senior manager here. He's a 20-plus year veteran of the financial market. Great musical knowledge abounds in Kevin, and he is here to help answer your questions in the chat. Also backstopping me today, we've got a great production crew that's going to be helping out to bring this webcast to you. And thanks to all of you for joining me, whether you're in the live version or whether you're in the recorded version. Thank you for being here. I'm noticing some of the usual suspects here, so I'm glad to have you with me as well. So we're going to talk a little bit about flags from the standpoint of kind of the classic flag experience. And we're going to talk about kind of the classic bull flag perspective. That's what we're going to look at today. But we might throw a couple of little twists into that discussion. For those of you who I met, Jerry and others, in the events that I've been at over the last couple of weeks, New York City Market Drive and the workshop that we just wrapped up last weekend in the Washington, D.C. area. Welcome and thanks to all of you. It was great to meet all of you. And let's jump into this discussion here really quickly. A couple of quick reminders. Everything we talk about is simply for illustrative and educational purposes only, not a recommendation or an endorsement of any particular security or strategy. We may talk about options today. We will focus a lot on stocks, but we're going to talk perhaps a little bit about options. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that spread trading must be done on a margin account. Multiple leg option strategies will involve multiple transaction costs. And remember, we're going to talk about technical analysis. That's kind of the basis, the heart of the bull flag pattern or the flag pattern in general. There are lots of different ways to look at the market. Technical analysis is only one of them. None of them are a guarantee about what may happen, and they are all, including fundamentals, theoretical in nature. So we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version. It's a great learning environment. However, it is not a guarantee future success. It doesn't allow for the early assignment of short options, so there's some characteristics that you have to pay attention to. We're going to be talking a little bit about stops today. So remember that stop orders, and in fact stop limit orders, trailing stop orders, all of those have some limitations. Those limitations specifically include the fact that we can specify the activation price, but not the execution price. And in the event of a stop limit order or trailing stop limit, there's the risk of missing the market altogether simply because the price moves around that limit range. And of course, as always, past performance, no guarantee of future results. So let's jump into this discussion and kind of have a quick agenda check. We're going to talk about what's going on in the current market. It's a relatively volatile day amongst a relatively volatile set of days this week for a lot of different reasons, not the least of which the election. I'm just going to caution you again, and we've had this conversation before throughout the day in the chat. This is a great opportunity to talk about that volatility that comes from the election. Probably not the best place to discuss political opinions or discussions like that. So keep that chat focused on the discussion about the market, and we'll be just fine. We're going to talk a little bit about flag patterns today. We're going to talk about a couple of examples. In fact, I've got a number of examples that I want to look at today. Again, none of those are recommendations. So let's just kind of take a look at the classic flag pattern for just a second, because this will kind of set us up for that perspective. Remember, our trend generally when we're looking at a bull flag is a bullish trend. I mean, that seems to make some logical sense. Time frame generally short-term, days to weeks. A lot of the flags that we're seeing now in this kind of market situation are existing on this kind of time frame. Maybe it kind of that outside edge of that short-term perspective, perhaps the intermediate time frame. Now, we've also taught in this webcast over the past few months, we've taught intraday flag pattern trading. We've taught trading flag patterns on a longer term basis. We've taught a lot of different approaches to this idea of trading flags. So today we're going to be, as I said, kind of serving up the classic flag pattern. And we'll see what that looks like. So we take a look at here, perhaps that flag portion, that first section of the flagpole from a major support level up to a resistance level or up to a turning point, from a bounce up to a bounce down. And then we see that little bit of a pullback, either a diagonal down channel, either a pennant, either a sideways consolidation channel. Regardless of what the shape of that flag portion is, it's simply a counter trend move or a pause in an existing trend. And then the entry comes at 2 points, either the bounce up off of support or the break of the resistance. In either case, evidence that the price of the stock is moving in a particular direction. In fact, the expected and desired direction in this particular case would be a move in a bullish direction, taking us out to that expectation. And the potential target would be this distance, that flagpole distance duplicated up here. So if this is distance X, then we would expect that the target would be up here at distance X as well. And you can kind of see that right there on that side. That's kind of what we're looking at here in this kind of classic approach. Now, we're going to throw a couple of different ideas in terms of how we might manage this trade, and how we might put the trade together, whether we trade it as a stock trade, whether we trade it as an option trade, whether we use stop orders, or whether we use options as a means to manage the order. So classic and a few other flavors today. So let's jump into that discussion really quickly here. Let me close that annotation out, and I'm going to switch over to the thinkorswim desktop software platform. And as I do that, this is a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. That way you stay connected to the Trader Talks webcast channel. If you haven't done so already, click on that subscribe button. And by the way, as Kevin posted out there in the chat, you can join us and follow us on X, formerly known as Twitter, at Ben Watson CS, and Kevin is at Kevin Horner CS. That's how you are going to find us there. So, by the way, speaking of Kevin Horner, he teaches a complementary class to this discussion called Breakout Patterns. So, flag patterns are simply an example of a bounce or a breakout pattern. It's a specific type, and it has some specific characteristics. Kevin kind of teaches the whole pantheon of breakout patterns, and that also includes breakdown patterns as well. I'll let Kevin throw his webcast playlist link into the chat as well. So let's take a look at what's going on in the market today. I mean, we said that likely to be a little bit of volatility, and we're kind of seeing that happening today. A little bit of a pullback right back down to the 50-period moving average and a bit of a bounce today. RSI starting to move higher, so we're starting to see some movement to the upside, kind of starting to crank here back to the upside. Now, will that last? Don't know. And again, technical analysis, fundamental analysis, probability analysis, none of those types of analysis will predict the future. They can simply give us a framework for making decisions. And so we see that little bit of a bounce up off of that support level at the 30-period or the 50-period moving average, and maybe running into a little bit of a resistance here on the SPX. Taking a look at the NASDAQ. Also a bit of a bounce, again up off of the 50, perhaps running right back up into some resistance levels again here. And the Russell 2000, the small caps, which coincidentally, over the last couple, maybe 3, maybe 5 election cycles, the small caps typically have been some of the bigger beneficiaries of election uncertainty relief, if you will. And starting to see that little bit of a bounce here again, up off of the 50-period moving average, kind of sounding a little bit like a broken record. One other thing I want to do here really quickly, I want to pop over to our VIX grid, and I want to take a look at volatility, and we can see the volatility is kind of bleeding out a little bit. That makes sense given the fact that maybe now, today, some of that uncertainty kind of unwinding in the market. We see volatility kind of backing off. Back down towards its, in this case, 30-period moving average of volatility, back down into the 20 handle, just kind of sitting right there on the bottom of that 20 range, right? So that being said, in this scenario, that volatility kind of moving down suggests that the market is kind of okay at this point, taking advantage of that bounce and a little bit of drive higher. Markets tend to like uncertainty, but at the same time, too much uncertainty brings higher volatility. Higher volatility brings the potential for movement, and around and around and around we go. So let's take a look at a couple of specific examples, and I'm going to pop over here really quickly to my single grid here in the thinkorswim platform. By the way, I'm just using the thinkorswim desktop version here. This is a this is a paper account made to look like a live account. It's a demonstration account. We're going to pop over here to General Motors, and thinking about classics, right? General Motors, one of those classic American companies, and also now perhaps an international company, but have been seeing this kind of upward trend over the course of the last year, seeing General Motors breaking out off of this little bit of a bounce and then breaking out to a new high and pulling back and continuing to expand that upward movement today with a little bit of a momentum increase. We saw the RSI pulling back a little bit. And you notice one other indicator that I put on this particular chart, and that is the ATR, average true range. Average true range, simply a statistical measurement of the typical move that the price of a stock makes over a particular time frame. This is a 14-day time frame. So the typical move that this stock makes on a daily basis over the last 14 days has been about $1.52, $1.51, $1.52. Right about where that is. So that's going to come into play when we start to put this trade together in terms of our expectations, number one, and number two, our protection for this trade. So this is a $53 stock. We're going to trade this one as a classic example, straight up. We're going to buy the stock. We're going to protect it with a stop order, and we're going to set a target with a limit sell order. And we'll put that together. And then once we have this classic trade kind of in mind and in hand, then we'll kind of change our variations. We'll add a little bit of syrup to that classic mix here. So we'll see what we're doing. Okay, so going back to this particular time frame, I'm going to zoom in and we're going to look at this in a little bit more close inspection. In fact, I'm going to make sure that I've got this kind of set up from a price display that I don't have any kind of expectations. What I had already done is kind of created an expansion area up at the top of that chart. I'm going to take that expansion area off because I want to kind of see this as it exists right now. So we can kind of see what that angle of that trend looks like, and we can see how steep this upward movement is. One of the hallmarks of a flag type of trade, as opposed to just a breakout above a resistance or a bounce off of support, is that there's a strong initial impulse move in the direction of the prevailing trend. So we could argue that this move plus this move here on the earnings announcement were very strong impulse moves to the upside in the direction of the prevailing trend, right? So we kind of have that in hand here. Now, what we're going to do, we had this resistance here. We have perhaps a little bit of a support level kind of right along the base at about that 50.75 mark or so. No, maybe 50.60. Not quite down to 50.5. There's that level of support. And what I would argue is that that's probably that whole area right there. We could draw that in with a big fat magic marker as an area of support. Support and resistance are very rarely bright lines on the chart the way that we draw them. They are oftentimes levels of or areas of support and resistance with a little bit of variability and some flexibility. And depending on the stock's volatility, maybe a little bit more variability and flexibility. If the stock is more volatile, a little bit less variability if that stock is less volatile. So when we take into account the ATR, average true range, is a statistical projection of volatility. right? It says, hey, this is about how much the stock has been moving. The ATR is lower when the stock is less volatile. The ATR is higher when the stock is more volatile. And in fact, this ATR right now is about the highest it's been over the course of the last year. So what does that have to do with our flag trade, right? This classic, perhaps, projection of a flag trade. Well, we're going to use that ATR in this particular case to protect this particular trade. So we're going to put a pin in that for just a second. We're going to come back and we're going to talk about it in just a moment, right? So as we come right back to this, let's pull into this view just a little bit more. So what gives us the opportunity or the signal to enter this particular trade right now as a bull flag, right? As a bounce. So there's a couple of things. And we got to think about this from the perspective of what is it that we're trying to do with this entry. The entry is confirmation of movement in the direction of the prevailing trend and in the direction of the impulse move. The impulse move is up. We're seeing confirmation of that. So one of the tools that we use in a bull flag type of perspective is this idea of a close above the high of the low day or a trade above the high of the low day. So if this candle right here is the lowest in this pullback or that consolidation phase of the flag, this candle right here, we were looking for a close above or a trade above that high right there. In this particular case, that's coming right about the 52 mark, right? About 52.18 or so, thereabouts, right? Not too particular, not too precise, but we're looking for a trade through there. And notice that this candle today has kind of engulfed that high significantly and seems to be moving up. Now, it's off of its highs a little bit, to be fair. But at the same time, we could do one of two things. We could wait for the close, but since I want to get this example trade in here, I want to take this trade as this trades above the high of that low day. The other thing that tells me that there's a little bit of confirmation here is that we have successively higher opens on these candles, right? So it opened here, it opened higher here, it opened higher here, and that's giving me an indication of some momentum to the upside. We're also seeing that momentum displayed here on the RSI, the relative strength indicator, pushing towards the highs, that RSI indicating that there's some upward momentum here. Now, some traders, and I will tell you this, there's another entry point, and Kevin will talk about this in his breakout trades class as well. Some traders may wait for a breakout above that previous high because it is relatively close to that resistance level. And there is the potential that this could pull back from that resistance level. But that's one of the reasons why we put a protection element into this trade. So let's see how we might put this together. The next thing that we're going to do is put a target on this trade, how far we think this trade might go. So for that, I am going to go back in and I'm going to add back in about 20% of room to the upside of this chart. It's not saying that that's where the stock has to go. It's not saying that that's how far it can go or anything else. It's just visually showing me another 20% higher. And what I'm going to do is I'm going to take that line that I drew from the previous support level, that previous major support that's drawn up to that previous high. I'm going to right click and I'm going to duplicate it. And then I'm going to take it and I'm just going to base it off of that support level. Now, I could base it on the breakout. I could base it on the close above the high of the low day. I'm choosing specifically to attenuate that somewhat by basing that line on the support level. So rally up, pull back, rally up. That's what we're expecting out of this trade. And so we might look for that target to be somewhere out there right about the 61 mark. And what I'm going to do from a visual standpoint is I'm going to just make that a dotted line so that we know that that's the potential target for this upward movement. So now we have a target, right? The target on this particular trade is up there around 61. Entry is going to be whatever we get here at the market price. And our stop, now we are going to place one ATR below that support level. So if it makes a move more than its typical move, we're going to exit the trade, theoretically, or close to that price, because remember, stops aren't exact. So let's put this trade together. All I'm going to do is I'm going to come over here to the price. I'm going to right click, and I'm going to do a buy custom with OCO bracket. Remember, this is a classic stock position. We're going to use 100 shares as our default here, but please make your own decisions as far as your position size based on the size of your account and your risk tolerance. We've got lots of great webcasts that talk about that and talk about determining position size. As a matter of fact, in Denver at the workshop, the technical analysis workshop that Kevin and I did, that's one of the things that Kevin and I talked about, was this idea of a fixed fractional method of position sizing. So use your own method, whatever you decide to do. So prices, the stock currently is 53.28. We're okay getting in. So I'm going to open up that lock, and I'm actually going to give it a little bit. I'm going to give it up to 53.35, give it some room to move while we're talking here, and open up that limit a little bit. Now, I'm going to set my target as this next line in the order. We said that our target was at 61. So 61 is going to be our target. If the price of the stock goes up to 61, then we're going to look at exiting the trade. I'm going to make that one good till canceled, okay? So that I don't have to recreate this, because it's not likely to make that move in one day. It could, not likely to do so. The next thing that we're going to do is we're going to set our stop. And in this particular case, we're going to go back to that ATR, and I'm going to say, all right, where's our ATR currently today? ATR is at 151. So I'm going to grab my left-hand side. I'm going to use my calculator here. I know that my support level that I based that off of was at 50.60. 50.60 minus 151, $1.51 equals 49.09. That's going to be my stop. So, this is not the only way that you can measure where you might place a stop, but it is an effective measure based on the current level of volatility of the underlying stock. So using ATR. Barb Armstrong, in the classes that she teaches, oftentimes will use that one ATR method. So we're just going to borrow from that, and we're going to set this stop at 49.09. We're going to make that good till canceled as well. We're going to double check and make sure that our limit is within the current price of the stock. We're at 53.35. We don't need to adjust that. 61 is our target, 49.09. So our risk in the trade here is about $4.28, right? $4 and some odd cents there of what we're risking in the trade for the potential to make in this move from our entry point up to 61. So about $9. So we're risking 4 to maybe make about 9. We're going to click on confirm and send, and we can see we're going to read through the order, make sure that we're aware of any alerts like the stop order alert. And again, there's no guarantee that this is going to reach that target. And in fact, that's the reason why we put that protective stop there, is to mitigate that downside risk somewhat. It doesn't guarantee exactly how much risk we're going to mitigate. We can specify the activation price at least. So buying 100 shares at 53.35 to open, selling it if it gets to 61, or selling it if it triggers the stop or activates the stop at 49.09. Where it fills, we don't know, but we're going to go ahead and we're going to click on send, and we're going to fire that order off, and boom, we are into that particular trade with that expectation of that price movement to the upside. So that's an example of a kind of classic approach to a bull flag trade, right? Kind of using the stock itself, using a target limit order to get out of the trade at the specified target, and using a stop order. And we base that stop order on one ATR. Now, do you have to put a stop on it? No. Do you have to put a target order on it? No. That's simply defining the trade to be that kind of short to intermediate term, almost swing trade, if you will, right? We could use this as an entry into a longer term trend trade. If that trend continues, you could specify how many shares you wanted to exit at that target. Doesn't matter. There's a lot of different variations. But let's take a look at another potential example here. And by the way, all I did to find these examples is I looked at stocks that were in my general watch list, and I looked for the appearance of a flag, visually identifying the flag, and then taking that and utilizing that as an example. And, one of the things that we as human beings are really, really good at, and some are better than others, is visually identifying patterns. And so when you practice seeing flag trades, or you practice seeing bounce trades or breakout trades, you're going to get better at that. You're going to get better at that pattern recognition, that pattern identification. So we're going to take a look at this next one here, which is Delta Airlines. I'm going to pop over to Delta Airlines, DAL. And again, this is, if we take a look at what's going on here, we've had a couple of these kind of very classic bull flag types of approaches, right? In this particular case, rally up, pull back, rally up. And we can kind of look at this as an extension and maybe a reach of the target in that kind of first classic flag pattern. But we're going to use this one because of maybe the fact that volatility is a little bit low and rising, because we just had an earnings announcement, and we've got an earnings announcement a little bit over the horizon, right? And would then, maybe look at trading this as an option. Tom asks a great question. In the case of that GM order, why might a trader decide to cancel that 61 limit sell order and then sell it at the market, just get out of the trade? And one of the reasons that a trader might decide to do that would be that the price of the stock starts to reverse, right? And, let's say, for instance, if the price of the stock, if we got into this flag trade here on Delta Airlines and we started to see that it began to flag again, right? You started to see flag pullback. If it's not consistently moving higher, then, especially with an option trade, you're losing out to things like time decay. But at the same time here, one of the considerations might be, in terms of maybe not thinking that the price of the stock is going to get all the way to that target, would be the break of a support level. So Tom, what an example of why you would maybe override that sell, cancel that sell order, and get out at the current price would be if the price of the stock starts to break a level of support. The other way that you could approach that would be, once you're in the trade and the stock starts to move and establishes some levels of support, start to move that stop order up to match where those support levels are, keeping that ATR distance current, so that if it makes a move outside of that range, then that stop order takes you out of the trade. But then you still maybe have that stop order out above that price to get out if it goes up, right? Okay, good question to ask. Great question to ask. So let's take a look at this stock. So what I'm going to do in this particular case is I'm not going to go all the way down to this support level here in this particular case. What I'm going to use, however, is I'm going to use this kind of shorter projection of this upward movement. You kind of had a little bit of a sideways pause here, but I'm going to use this support level right here, about the 46.60 mark or so, as the base of this flagpole, kind of that first portion of the flag. And oftentimes you'll see that that's what happens. You get a parade of flags. They kind of string themselves together. So I'm going to use that, and I'm going to run right back up to this previous high. That's our flagpole portion. And this is maybe more going sideways than it is pulling back in a classic kind of pullback flag, but that's a consolidation as well. And I'm going to use the reason to enter here as this kind of break above or trade above the high, and it's right at it, the trade above the high of that low day. Here's the low day in this sideways pattern. It's this candle right here. So the high of that day is 58.12. We're above that by about 16 cents. Okay. So I'm going to use that as the raison d'etre to get into the trade in this particular case. And we're going to look at setting that target. And once again, I'm going to zoom back out. I may even have to add a little bit more room to the upside, but I'm going to take that, I'm going to duplicate it, and I'm going to drag that up here to the support level. And I'm going to say, here's our target right up there about 70. I'm going to call it just 70, just for easy math. And maybe we back that down a little bit, but we'll call it 70. I'll edit that so that we can see where that target is. That's our target. And our support level here in this particular case at 56.80, right? Yeah, we do have, I think, in this particular case, a close above, or at least a trade above, Ram. A trade above the high of the low day. It's 16 cents above the high of that low day today. So that's going to be our reason for entering the trade. But we're going to do this with an option trade. Okay. We're going to use this as an option. So we're going to look at buying a long option, and we're going to sell this if the price of the stock goes up to 70. We're going to exit this because now our ATR in this particular case is $1.74. So our exit in this particular case is going to be our support level, which we said was at 56.70. I'm sorry, 56.80, 56.80 minus 1 ATR, which is $1.75. So minus $1.75 means that we're going to exit the trade at 55.05. Right? That's going to be our break. Right? Okay. So you're right. And Kevin, Kevin has a great comment here. If we wanted a little more confirmation, we'd wait to the end of the day. Right? But we're going to protect ourselves with that stop order here in this particular case as well. So here's the thing. We're going to come over here to the trade tab to put this one together. Okay. So in terms of going to the trade tab, and again, here's where we start talking about options. So if you're unfamiliar with options, this is a great opportunity for you to remind yourself to go to Barb Armstrong's Getting Started with Options class. It's a 12-week series. She starts at 1 and works her way through 12 and then comes back and starts it again. So if you're not familiar with trading options, great place to get started. But just for the sake of this discussion, we're going to go out about 45 days in time. I'm going to go to the 20 December expiration. And I'm going to buy an option that is a little bit in the money, that has a higher delta, greater sensitivity to the directional price movement of the stock. So I'm, in fact, in this particular case, I'm going to buy, and it's got a 10-cent wide bid-ask spread. It's got a narrow bid-ask spread. I can dig into open interest and volume if I want to. I don't need to because I recognize that that is a fairly narrow bid-ask spread. On this stock, it is a fairly liquid stock. These are fairly liquid options. And so I'm going to go to the 55 strike. I'm going to look at buying that 55 strike. So here's what we're going to do. We're going to right-click, and we're going to buy custom with OCO bracket. But watch what we're going to do with this. So because I don't know, because of the change in implied volatility, because of the change in time, I don't know what those option prices are going to be if the price of the stock goes up to our target or down to our stop. We're going to use conditional orders. So I'm going to use this price to get into the option, but then I'm going to change these two orders, the order to exit to a market order, and I'm going to change this order to a market order. And you see right now where it says plain market orders may not be part of an OCO group. We're not going to leave them plain. So here's what we're going to do. I'm going to come over to the right-hand side, and you see that little gear icon. Okay. So remember we said that our target was up at $70. So I'm going to click on that gear icon, and that opens up my order rules dialog box, which says, in this particular case, sell the option contract at market. Okay. We're going to make that good till canceled. But we're going to do that when this condition is met. When Delta Airlines marks at or above, greater than or equal to, that's at or above $70. Okay? So we're basing that order on the price of the stock. Okay? That's our target. That's the target for the price of the stock to go to. And I don't know what the option is going to be priced at because of changes in implied volatility and passage of time. But I'm going to go ahead and I'm going to click on save. Now that's got a conditional on it. Now, the other thing to think about here is if we go to the chart, remember here's our stop. We said that our stop was going to be at 55.05. So we're going to go back to that buy order. And we're going to use this exit order. We're going to change that to good till canceled. We're going to use the gear icon over here to bring up our order rules. And we're going to say sell this option if it goes down, if the price of the stock, Delta Airlines, goes to or below, at or below 55.05. So now I don't need to calculate what the theoretical price of the option is going to be. I could do that if I wanted to. All I'm doing is I'm basing this order on the price of the underlying stock, either going up or going down. And I'm going to go ahead and click on save. And now we've got an order to exit if the price of the stock goes to 70, an order to exit if the price goes below 55.05. And I'm going to click on confirm and send, and I'm going to read through this order. And we're still allowing that stock to move higher. We're taking advantage of the leverage of the option contract. I'm going to put this order in my trading flag patterns group, make sure that I'm aware of any alerts that might be down here. And I'm going to click on send, and we're going to fire that order off. Okay. Now, one more order type that we're going to use here, one more variation or twist on this classic, right, is we're going to use a variation on the protection of how we put this trade together, right? Yeah, exactly. Thanks, Kevin. I appreciate that. So here's what we're going to do now. We're going to take a look at another one of our examples. Let's take a look at, in this case, Capital One Financial, COF. So here's Capital One Financial. Looks a lot like Delta, doesn't it? Looks a lot like Delta Airlines. But what we're going to do in this particular case, it's a little more expensive priced stock, but we're going to use the stock again in this particular case, and I'll show you why. We're going to use the stock. We know where our ATR is. It's at about 4.32. We're going to look at getting into the stock. Now, watch what we're going to do in this particular order. So our reason for entering the trade is that trade above the high of the low day. There's our low day. It's trading above the high of the low day. And let's set our target here. I'm actually going to go not to this level of support, but I'm going to go back to this level of support right here. I'll even kind of attenuate that somewhat. We'll kind of even that out. We'll say, all right, here's our level of support. We'll go back up to the high. We'll right click on that and we'll duplicate it. Whoops, I don't want to duplicate that one. I want to duplicate this one. This was the one I want to duplicate. We'll grab it. We'll stick it on the support level right there. That says that our target is right up here at about 184. All right, 184. Okay, so watch what we're going to do. We're going to try to create this order, and this is going to be interesting, right? Right? Yeah, and we can do that all in one particular leg. You could do that all in one leg if we wanted to, Steve. I like to do it for the purpose of clarity, to make it a stop and or a sell order and an exit order, so that you can see exactly what we're doing. So here's what we're going to do. I'm going to go to the trade tab. Actually, yeah, I'm going to go to the trade tab, and we'll build this in the trade tab, because what we're going to do first of all is I'm going to look out a little bit further in time here. I'm going to say out about 45 days to go until expiration. And I'm going to see what strike prices I have on the call side that kind of line up with this. And so our target was up here at around the 184 mark or so. So I'm actually going to go back to that trade tab, and I've got the 180 strike. And if I were to sell that 180 strike, that's going to be bringing about $3.30. Okay. And then if I'm going to protect this stock, this trade, I'm going to look at that support level, which is about 160, and I'm going to subtract from that about $4.33. So we're going to go 160 minus 433 is about 155. So we're going to go to the trade tab. We're going to say, do we have a 155 put that we could buy? And the answer to that question is yes. We've got about that 155 put that we could put in place here. So what we're going to do is we're going to create this order as a caller. So we're going to do this all in one order, all right? So we're going to do this as a caller with stop. So I know that I'm going to buy the stock, and I'm going to adjust my strike prices. So the stock's currently trading at about 165. So I'm going to go right about here to the at the money strike. And I'm just going to simply click on the ask price because we're going to buy this. We're going to buy the underlying stock, right? But now I'm going to adjust my strike prices, and I'm going to put my put option down here at 155. There's my put. And I'm going to put my call option up at about 180. So what we're doing is we're creating a caller, a short call above, a long put below to provide us protection in this trade. And now we're going to buy the stock. And essentially what it becomes, the stock's trading at 165.56. We're going to be buying this at a 166.46 net debit. It's going to cost us a little bit, but we're putting that order together the same way we did before. Because if we click on confirm and send, here's what we see happening. If the price of the stock goes up to 180, then potentially it would be called away. If the price of the stock goes down to 155, then that put starts to gain intrinsic value, and it also gives us the right to sell the stock at 155 exactly. So this order essentially becomes, this buy stock with caller essentially becomes a similar bull flag type trade to what we just did, but we're using the underlying stock as the driver, and then we're using a short call as an exit, and we're using a long put as the protection. And we'll go ahead and we'll put this in our trading flag patterns group as well. Click on send, and we'll fire that order off, and we'll see that that if that fills. And as Kevin says, that gives us a risk-defined approach, and it gives us a protection. And you're right, Josh, exactly. The caller acts as a profit target, and the put acts as a stop loss. So the short call, profit target, long put, acts as if it were a stop loss. But again, remember, it's different from a stop loss because it has an expiration date, and it's going to go away. Plus, it's going to suffer the ravages of time. So something to pay attention to in that difference. But that's kind of the approach as we put this together. So those are the three trades that we put on here, the three examples. So classic flavor, then we used options and conditional orders, and then we put on an order buying the stock and creating the caller trade, in this case, buying a caller. It was not a no-cost caller, but we bought the caller, and there it went. It filled for us, and so we're into that trade as well. And so all three of those examples filled for us. So again, if you want to learn more about these strategies, great place to do that is over here on the Trader Talks webcast page. And you can, if you wanted to learn more about callers, just type in that word caller right there, and you can see all of those webcasts that come up. And you can find our webcast list and our in-person events right here at schwab.com/coaching. I'm going to be in Nashville coming up this weekend with my good friend Kevin Hinks. We're going to be talking options and advanced options this weekend. It's going to be a great event. So once again, guys, thanks for joining me today for this discussion. We talked about a couple of different examples, classic flags plus a couple of twists. And my thanks to Kevin Horner for helping out today and answering those questions. My thanks to our great production staff. And you've got lots and lots of resources there in the Trader Talks webcasts archives to find out the differences between callers and those OCO brackets. Thank you all for being here, and we'll see you again very soon. Take care, everybody. Bye-bye.